Let's connect with Sandip Sabharwal as well, who is joining in on the show. Sandeep, hi there. Good morning. Let's get in your views first up as to what the outlook is when it comes to the entire IT basket. Are you now seeing that renewed interest in particular when it comes to some of the mid-cap IT stocks?
Yeah, the IT stocks have been buzzing. It's like some, especially like you rightly said, on the mid cap side, have been buzzing around. But I think the macro outlook continues to deteriorate for these companies. So I think there is some sort of disconnect which is there. So I think, especially on the large cap side, valuations are reasonable, but growth outlook again is hazy. So I would think that we have to be very, very selective in IT, even if people want to pick. But otherwise, the sector broadly remains a void at this stage.
Sandeep, there is also commentary coming in from Bata today. I want your reaction on that. Again, the entire space, all this footwear stocks, some of them were very kind of overvalued, but Bata is a old hand out there. Now they are saying that not completely committing on that news on strategic tie-up with Adidas, but are saying, yes, we are discussing potential tie-up with multiple global peers. Do you think Bata can, regain its lost ground or the shine it used to have once?
Definitely. I think among the consumer stocks, this is one stock we have been accumulated at lower level, not at these levels. And the thesis is that on the footwear space, they have a very strong presence. Their recent forays into newer type of footwear, especially sneakers, their move into that has been accepted well by the market. The overall footwear industry has been on a slowdown in India, but I think Bata is pretty well positioned. And any such tie-up or global sourcing for the parent, which also has been under discussion for some time, but timelines are unknown, could be a significant positive trigger. So I would be positively inclined on Bata. And since they are saying that they have confirmed that talks are on, so I think that is a positive because till yesterday there was some news flow, but we were not sure whether something is happening or not. So, and going ahead, I would think that footwear, which has been on a downturn for at least the last couple of years, will see a revival as there is a particular cycle which plays out in footwear. So where the replacement cycle, etc., will also come about. So I think it's a reasonable bet.
Meantime, also wanted to get in your take, Sandeep, on some of these life insurance stocks. Given the fact that in the quarter gone by, you did see a pretty decent growth, the likes of SBI Life, HDFC Life, etc. What's been your assessment?
So I think essentially the cycle they followed was that they sold off after the budget, and after that there was a huge revival. At these prices, I think they factor in all the positive growth prospects of the near term, and to that extent, finding value at these prices after the rally they have seen is tough. So I think we need for these stocks to give up some gains before they again come into buy zone.
Weakness in HDFC Bank. And data is suggesting that in the last 2 weeks, there's a lot of short pile-up which has happened on HDFC Bank, which is weighing in on the bank nifty. Pull up the last 1 month graph, you would see that from upwards of 1700, in fact, closer to 1750, the stock has been coming only one way down, almost 90 bucks. So there's not only delivery-based selling, but active shorting happening there. Sandeep, I would want your opinion on this one because I know you're tracking what is happening and how shareholding pattern, market acceptance on this merger. Today, Investec has come out with a note saying that post-merger, P&L of HDFC could actually be lowered. And there's a lot of uncertainty and risk which market is trying to understand regarding the P&L impact post-merger. Do you expect this to continue, the underperformance, the weakness in HDFC Bank, Sandeep?
See, I think most of the analysts underestimated the impact on margins of the entire merger process with HDFC. Many people were betting on some relaxations from RBI which did not come. So their SLR, SCRR requirements at a time when the liquidity is actually tightening. And HDFC Bank, everyone has to realize, has a huge market share in the CASA deposits already. So for them to increase it further is tough in the near term, or whatever efforts they might make. So, and housing finance in any case was a business where margins were getting squeezed due to increased competition. So this merger was not in the interest of minority shareholders, and it's gone through now. So I think people have to accept it and evaluate the company as a whole. So I still believe next couple of years, at least 6 quarters, will be tough for HDFC Bank, and to that extent, that's getting reflected in the stock price movement. I would think that underperformance could continue for some more time.
Deep, I just wanted to understand whether or not you've been a buyer at all in the recent market decline along the Q1 earnings season, anything that you may have added positions to or bought afresh?
So my view was that we'll still see some correction. So I just waiting out for the correction to play out. And in terms of results, I think among the slightly larger companies which reported interesting results and outlook was Bharat Forge actually. So finally, their various diversification plays seem to be making a headway on the defense side. Also, they're making some headway. So I think this is one stock people should keep on their radar to buy on declines.
Just wanted to get in your take, Sandeep, but given the fact that we have seen a lot of rush when it comes to the multiplex, the footfall seems to have recovered with the kind of film releases that we've witnessed. Hotel bookings as well, prices have spiked up quite significantly. Within this entire space, what is it that you would look at as strong opportunities, the likes of Indian Hotels, Mahindra Holidays, PVR Inox, etc.?
Yeah, so PVR Inox continues to be a reasonable bet even at these prices after 15-20% kind of rally, because people are just written off the stock in the sector, and now there's a certain rollback and things are actually much better than they ever were. So I think that's a disconnect. There's a set of people in the market who still believe that and will not buy these stocks because they believe OTT will take over and no one will go to watch movies. So I think those people won't buy, but otherwise it's a reasonable bet. Hotels continue to do well, and I think the next couple of years should still be strong for hotels. International tourism still has to pick up, and I think that could further add to gain, especially for Indian hotels coming into the winter holiday season. So Indian Hotel, Lemon Tree, both are reasonable plays even still.
Deep, what could trigger this? Are you observing some of these, global headlines over the last 2-3 days? Yields are shooting up, dollar index is rising. There is a lot of risk off in the global kind of setup. But the same kind of thing, risk off is not percolating in India. Especially in the mid caps, we are seeing net inflows. Even Goldman Sachs, now Goldman is saying that FIs are preferring Indian mid cap, small cap.
Yes, I think that phenomena, like you rightly said, is happening. Global headwinds obviously have been building for some time. Given all the points you pointed out, yield spike, dollar index moving up, possibility of slower growth, reduced earning gap between bonds and equity. I think that's a play which has been there. So that's reflected in the FI outflows out of India and the correction in large caps. Mid cap side, there's too much of domestic flow, and that's supporting many of these stocks. Yeah, so I think eventually we'll see a correction in mid caps also. Timing remains uncertain. Maybe in October, November that could happen. But I think whoever is buying very high flying mid caps, which have rallied 40, 50, 60% in just 2-3 months, they need to be ready for a 20-30% correction which can come anytime. So I think people need to recognize the risks which are there in the market also.
Yeah, of course not. In fact, we were looking at the Goldman Sachs note on pockets of mid caps where FI concentration is high. And Sandeep, you may want to comment in here. The FI favorite stock list is Max Healthcare, Shriram Finance, Axis Bank, AUSFB and Sona BLW. Interesting that, autos finds a large play, and not pure play autos, but ancillaries and financiers like a Shriram, like a Sona BLW.
Yeah, financials always have been a favorite of FIs in India, and they have made money in them also because that's been a segment which has grown a lot, and that's been a segment where new companies have come up and they have generated wealth. So I think that both in terms of private equity as well as foreign investors on the portfolio side, they've been favorites. And I think to that extent, it will continue long term also. But then at various points of time, we've seen that they become very overvalued and some of these stocks give sharp corrections also.
Okay, that's the view coming in on some of those FI favorites and, of course, the additions that have recently been made within the entire mid-cap arena. Meantime, let's also get in a take as to what your outlook is, Sandip, when it comes to the entire metals basket. Where is it that your preference lies?
No preference on metals. I think metals and commodities in general, see, crude is being held on by the cartel, but otherwise, the commodity outlook is not positive at all. What is happening is China is going to create significant downside across the commodity world. They're already down and they remain down for a long time. The primary commodities, chemicals, specialty chemical, anything you name, it's not going to be an easy time for them.
What are the commodity users which are there on your list? Because somebody's gain is somebody's loss is somebody else's gain, right? So if commodity actually melt up the way you're making a case, it would hugely give boost to the margins of many of these commodity users. So apart from Bharat Forge, any other commodity user which you have on your list which you would buy at 20% lower?
See, many companies and many industries immediately come to mind would be tire companies. They've done well, but they could still see sustained margins. We could see improved or sustained margins in many of the automobile companies or capital good companies, because I think commodities will remain subdued for a long time. There'll be spikes in between because of various factors, but directionally, the trend is not strong.
Sandeep, since you do believe that the market is set to decline more, and that's the opinion even Kunal and Naresh have, where do you think are the pockets of froth? Where is it that you would say, steer clear from here?
So I think which goes around after results that worst is over for some companies and you should buy them. So I think that's a wrong thesis. So where companies are doing badly, some of those companies will continue to do badly. So this specialty chemical space, I think many of these stocks are down 30-40% from the top, but they went up they are still up 400-500% from the bottoms of 2020. And their margins are going to collapse. And this is one segment where people should just be very careful next 2-3 years still.
Yeah, the commentary from some of these large chemical players along the sidelines of the Q1 numbers has been quite weak. And it seems like it's more of a structural issue, not transitory in nature by any means. But Sandeep, great to have you on the show. Thanks as always for taking the time out.